Good morning. How are you today? It's Bruce here. It's Uncle Bruce here on Stock Markets with Bruce for Monday, May the 17th, 2021. Cheers to all of you from around the world. The big talk this morning is a merger that is being coordinated between AT&T, which owns Warner Communications. Remember AT&T, Time Warner and all that? And then there's Discovery, the Discovery Network. And the Discovery Network people and the AT&T Network people are going to create a new company, a third company, of which AT&T shareholders will own 71% of, Discovery shareholders will own 29% of, and this new company will basically be made up of parts of both these companies. Warner Entertainment is going from AT&T into this company, and Discovery is putting a bunch of their assets into this company. Why and what? No, why should we care? Because what does it have to do with anything we're following, right? Always that question too. Couple of little more details for you. The Warner Media Company. All right, I've been looking into this all morning, trying to figure out what do they own and why do we care? Why do I have to bother with this stuff? Well, we have to bother with it in a way because this is sort of a symptom of the market. Warner Media owns CNN, HBO, HBO Max, TBS, Time Warner Movies, TMZ, Cartoon Network, Cinemax, DC Comics. That's Warner Media, and that's not all of it. That's just some highlights for you of what that is. And that is a multi-tens of billions of dollar entity. It's huge. It's just massive. Discovery, all right, what do they have? The Food Network, Home and Garden TV, TLC, Animal Planet, the Travel Channel. They own the Oprah Winfrey Network, the Oprah Winfrey Network, Science Channel, Discovery Channel, of course, Motor Trend, and more and more and more. So what's happening here, what they're trying to put together, I think, is Discovery, by putting a bunch of their assets into a new company and Warner Media being put into a new company by AT&T, Discovery now is trying to become this sort of streaming company. Like with HBO, you don't buy you can buy HBO separately if you want, subscribe to it separately, or you can go to Disney and subscribe to Disney separately, or you can go to satellite television providers and subscribe to them separately. Netflix, you subscribe to them separately. Hulu and all these other streaming services that are out there. And I'm not a media expert in that whole thing, but content is what it's all about, and streaming is what it's all about, and you've got to get your share of it. Now, Food Network, Home and Garden Television, TLC, Animal Planet, Travel Channel, these are all channels on our cable systems or on our satellite systems. And the Discovery people know that they have 95 million viewers, 85 to 95 million viewers or subscribers to each of these channels that they have. It's mind-numbing. And then, of course, Warner with HBO Max, 100 plus million people into that. TMZ, TBS, Warner, the Film Network. There's all kinds of subscribers on that. So all of these are now being put together into this new little company, third company. It's kind of it's just a merger deal, and there are virtually no tax implications, which is also brilliant on the management side. But for AT&T, what it does, it allows them to divest of an asset that they are managing, but they could use better management and more potential exposure of their product. And Discovery gives it to them. Discovery knows how to manage networks. And now you've got content and networks together being put together into one unit. And for AT&T shareholders, it's a win. For Discovery shareholders, it's a win. And I'm not sure quite how to look at it. I'm still trying to absorb all this. I'm an old guy at 65, and I don't own stock in any of these two, and I've never recommended any of you own stock in any of these two, although I have said lately I like the dividend that AT&T is paying. And from what I can see here, that dividend is safe. The AT&T dividend will continue to be paid out, will continue to be juicy, and AT&T, in their case for sure, are offloading probably 45 to 50 billion dollars of debt that they're carrying on the Warner Media side. In other words, the entire Warner Media assets and the debt and the cash flow and everything all goes into this company. And then Discovery puts their assets and whatever assets those are, and I don't have the exact detail, they're all cash flowing and profitable too. They go in there that can carry all that debt and more and can expand and so on. So for AT&T shareholders, the debt that they used to have from the Time Warner division is now transferred to a new corporation, lowering the debt load of AT&T dramatically. Owning 71% of a new company that's a larger entity than just Time Warner by itself, obviously, because you put the two together. And I think for AT&T shareholders, what will end up happening is that they will get some kind of a stock dividend. They will get like if you're a shareholder of AT&T, you're going to get a share of this publicly traded company. From what I can understand, if AT&T does some kind of a dividend, but this is yet to be seen. I'll be following this, as you can imagine, because this is like 15, 30 minutes old. It's not that old. And we'll see what happens going forward. What does it mean to us? Well, it's showing me already and in real time how the market is evolving in front of our eyes. And that when an outfit like AT&T, that is a massive company, can in one fell swoop take 50 billion of its debt and just move it over here, why would they want to do that? Because interest rates might be going higher over the next few years. And that's the gamble that I think is going on here. AT&T might be thinking that the rates are at the low now, and while at the low, reorganize, take whatever debt you have that's higher debt, if there is any higher debt, shove it off elsewhere, reduce the stress on your balance sheet, and merge with another entity that's dying to get into your business, like Discovery, form a joint venture, make that deal happen, but offload a huge liability or a huge overhead, and yet still own 71% of the upside. I just, it's brilliant. It's a brilliant move. So for AT&T shareholders, I think they're going to do very well. It won't mean a dividend increase for AT&T shareholders as far as more money coming out every 3 months necessarily, but it will probably mean higher earnings for AT&T because they've just lowered their expenses. And I'm going to watch, obviously, going forward, other deals coming with other entities, because when you're at market highs, which is where we are right now, all-time market highs, you're beginning to notice, or at least I'm beginning to notice, interesting looking deals starting to kind of happen, because when your stock is at an all-time high, it's time to make deals. It's time to use your security, your stock, your paper, as an asset, as currency, I guess what I'm really trying to say. And I'll go back over to what we're watching. We're watching our friends at GameStop. We're watching the AMC story evolve. We're watching IPOE, which is SoFi Capital. June 1, it will be SoFi on the New York Exchange. That one is going to be one to watch closely for us, because don't be surprised if in the first 3 months of SoFi's existence that they perhaps might be an acquirer of other banking entities, maybe some regional entities or other areas online. I don't quite know everything, but they might pick off, a car loan company. They might pick off a more brokerage interests, investment banking interests, and they'll use their stock as collateral, as cash, in the form of cash, in lieu of cash, to attract in other assets. It won't be at $10 a share. It won't be at 15 a share where they are now. It won't be anywhere near these prices. They're going to be substantially higher, because the street is going to figure it out that SoFi Capital is a quickly growing monster online banking monster. It's going to become the dominant one. And for Sofi to survive as a standalone company, they have to become so big that they can't be taken over by somebody else. My other brain, the other half of my brain is saying, yeah, but watch out if Walmart comes in or if Amazon comes in and says to Sofi, look, guys, you're cute and all, and you're worth 10 billion, 15 billion. Way to go. You took over the SPAC and you're public now, and you've grown you've grown from the $8 billion value you had on June the 1st, 2021. You were 8 billion then, or 8.5 billion, whatever it was, and you quickly became a 15, $20 billion company, and your stock went to 30, 40 bucks a share. You made all your SPAC people a pile of money. Great. That's just super. However, we at Amazon, we're a $1.6 trillion company with a T. You're a $20 billion company with a B. Why don't we make a deal? And we'll just take you over at 200 a share, 300 a share, 400 a share, maybe 3 months, 6 months down the road, a year down the road. We'll take you over 400 a share. We'll just do a stock swap. And you're now going to become Amazon shareholders at the equivalent of $400 a share on the open market for your stock. Happy with that? Anyone buying at 15 is going to go, gee, $15 in, $400 out. That's 26 times my money, 27 times my money in a year and a half. Gee, should I do that? Yeah, that could happen. Now, Sofi could very well, in the first 3 to 6 months of its existence as a public company, try to grow themselves into the $50 billion range, not the 15, 20, 25 billion range, but 50, by using cash and or stock that they have, the ability to borrow money through bond offerings, raise capital, and acquire other entities to bring them in and grow the company out that way, and become like a Lego, kind of like building a Lego machine, one piece at a time, building 5 billion additional assets of again and again and again and again, becoming a 50 billion, 60 billion dollar company, so that when a larger company comes calling, it gets even more expensive to take them out. Or can these guys grow quick enough, fast enough with their subscription counts and customer counts and acquisitions to become a 100, 150 billion dollar company in the first year or two of existence, and hold off the possibility of a major company taking them out? Welcome to the stock markets, kids. It's whales eating whales. It's little fish gets eaten by bigger fish, gets eaten by bigger fish. And with AT&T, there was the Time Warner deal. Then there's the CNN acquisition with Turner Broadcasting. On and on go these deals, and now we have this new company being formed by Discovery and by AT&T. And this is a new company. It's going to be worth like 50, 60, 70 billion dollars. I mean, it's just out of nowhere, a $70 billion mega company exists. Huge, just whoa, a whole new world which we live in. Again, I am trying to absorb this and try to explain it to you in plain English today, in the very early moments of the deal, to give you folks a heads up that do not be surprised in the next few months. We begin to see a lot of proposed mergers and acquisitions of entities, because you can grow certain ways. You can grow organically, or you can grow by acquisition and merger. And a certain company will reach a certain size and will all of a sudden become noticed by a larger company over here, whether they're in direct competition or there's synergy. And this is how deals are done and how mergers are put together, and hopefully shareholders all benefit. With our SPACs, we are seeing, obviously, mergers happening with our SPACs. Obviously, these SPACs have been listed. They've got their money in trust sitting over here. They're publicly traded, where you can buy and sell these shares all you want. And there are these private companies that are, finding each other. The private company and the SPACs finding each other, cutting a deal, making it happen. So we're already involved in mergers and takeovers and acquisitions if you're into SPAC stock like we are. But it's going forward from here. What happens next, and what kind of game plan do these newly created public companies have to become larger?